I thank by noting that Senator McCaskill will not be with us today. As some of you know, she's home in Missouri attending to some very important health issues. We wish her well. We know she'll be back with us soon, I hope as soon as next week. And I will say I suggested to her that we postpone this hearing until she got back, and her answer was no, that there's lots of work for our subcommittee to do, and we should allow the Senate's business to go on, which is the way she is. I appreciate her attitude. She will be submitting questions for the record, and I want to, on behalf of the subcommittee, thank her staff, Senator McCaskill's staff, for their hard work in preparing for this hearing. We're here today to discuss the administration's unfortunate adventure in the healthcare startup business. That's kind of how I look at this. The Affordable Care Act created something called the Consumer Operated and Oriented Plan, or co-op program. It was really a gesture to those who favored a public option and were not successful in advocating for that. Under the co-op program, the Department of Health and Human Services awarded $2.4 billion of taxpayer money to 23 nonprofit health insurance co-ops. As of today, of those 23, 12 have failed. These 12 collectively received about $1.2 billion in taxpayer money that is almost certainly lost. And we can talk about that later in the Q&A. Their collapse, by the way, also caused 740,000 people in 14 states to lose their health insurance provider and have to scramble to find new coverage, most with little or no time. Over the last 9 months, our subcommittee has carefully investigated these failures. We wanted to know whether HHS, when it played the role of investor, made good or bad decisions with taxpayer money. Unfortunately, what we found out is that a lot of bad decisions were made. In a majority staff report released today, we detail those findings. This report is here, and you all should have it. We detail findings that HHS was aware of serious problems concerning the failed co-ops enrollment strategies, pricing, financial forecasts, and management before the department ever approved the initial loans. Once the co-ops got going in 2014, things went south in a hurry, both in terms of financial losses and enrollment figures that wildly deviated from the co-ops' own projections. The failed co-ops ultimately racked up $376 million in losses in 2014 and more than $1 billion in losses in 2015. But despite getting regular reports that co-ops were hemorrhaging cash, HHS took essentially no corrective action for over a year. Worse, the department approved additional loan awards to 3 of the now failed co-ops. This happened in 2014. Now, this was despite clear warnings that these co-ops did not have reliable plans for turning things around. The majority staff report explains these findings in great detail, and without objection, that report and its appendix order to be made part of the record. Let me give you a few highlights. When HHS approved startup loans for the failed co-ops in 2012, it asked a reputable firm, Deloitte Consulting, to evaluate the co-ops' proposed loan applications and business plans. We have reviewed Deloitte's analysis as part of our investigation. Here's what we found. You will probably hear from our witnesses that Deloitte gave the co-ops a, quote, passing score, but it was based on a grading scale set by HHS, and Deloitte warned HHS of very specific concerns with the failed co-ops that foreshadowed the problems we'll talk about today, the problems that were to come. They said, among other things, many of the failed co-ops could not identify their senior leadership team. 7 of the 12 had serious deficiencies in their enrollment strategy, which later turned out to be the chief reason for co-op failure. Many of them submitted budgets that were incomplete, unreasonable, not cost-effective, or that didn't align with the co-op's own financial projections. Those financial projections weren't so hot either. Deloitte warned that several co-ops relied on unreasonable projections about their own growth. Just one example. Deloitte noted that Co-Opportunity, a co-op for Iowa and Nebraska that I imagine Senator Sass will be talking about a little later, had a target profit, quote, much lower than the industry benchmark, end quote, of 4.8%. That was an understatement. Co-Opportunity's stated target profit margin was 0%. Nevertheless, HHS approved all loan applications to the failed co-ops to the tune, again, of $1.2 billion. After they entered the marketplace in 2014, the co-op's financial health deteriorated rapidly, and HHS knew it. The department regularly received key financial information from the co-ops, including monthly reports and audited quarterly financial statements. These reports showed that starting almost immediately, the failed co-ops experienced severe financial losses that exceeded even the worst-case scenarios outlined in their loan applications to HHS. Cumulatively, by the end of 2014, the failed co-ops exceeded their projected worst-case scenario losses by at least $263 million, which is 4 times above the projection. The co-op's enrollment numbers were no less problematic. According to the 2014 monthly report submitted to HHS, 5 of the failed co-ops dramatically underperformed enrollment projections, while 5 others overshot their projections by wide margins. Both errors can cause serious financial losses, and they did. Low enrollment means insufficient income to cover expenses, of course, but excessively high enrollment was an even greater threat to solvency because it multiplies losses rather than profits when those premiums are underpriced, as many of the co-op premiums were. Despite having that information at its fingertips, HHS did not step in. The Department's loan agreements with the co-ops entitled it to invoke a number of accountability tools for borrowers who were missing the mark. But here, HHS chose to take a pass. Inexplicably, for over a year, the agency took no corrective action, nor did it put any co-op on enhanced oversight. 5 of the 12 failed co-ops were never subject to corrective oversight. 5 of the 12 failed co-ops were never subject to corrective action by HHS, and HHS waited until September 2015 to put 5 others on corrective action or enhanced oversight. 2 months later, all 12 co-ops had failed. HHS also had the power to stop dispersing funds if a co-op's financial viability was in doubt. It never did. Never did, to the bitter end. Instead, over the course of 2014 and 2015, HHS dispersed $848 million in federal loan dollars to the failed co-ops, even as those entities lost more than $1.4 billion. That's about 1.65 in losses, $1.65 in losses for every dollar that HHS gave them. Think about that. More unbelievable, near the end of 2014, HHS approved additional solvency loans for 3 of the failed co-ops that were in danger of being shut down by state regulators for having insufficient capital, despite clear warning signs that those co-ops could not turn things around. Here again, HHS asked Deloitte to complete an external review of the co-op's application for additional solvency loans and their plans to improve the finances going forward. But according to Deloitte, HHS truncated its review of these applications. Deloitte did not evaluate, for example, quote, the likelihood that each co-op would achieve sustainable operations based on the revised business plan, end quote, which I would have thought was the whole point. But even the limited analysis that HHS allowed Deloitte to conduct pointed to clear warning signs that co-opportunity, that the New York co-op and the Kentucky co-op did not have a sound plan to regain their footing. Nevertheless, these 3 co-ops alone received $355 million in additional solvency loans from the taxpayers. All have failed, by the way. The Kentucky co-op collapsed after suffering losses of over $50 million in 2014 and another $115 million in 2015. At the time of Co-Opportunity's closure, that company's operating losses exceed $163 million. And most staggering of all, after HHS gave the New York co-op $90 million to prolong its financial life rather than allow it to scale down, that co-op went on to lose another $544 million in 2015. The financial aftermath of all this is dire. The subcommittee obtained the failed co-op's most recent financial statements, and those statements show that none of the failed co-ops have repaid a single dollar, not a single dollar, principal or interest, of the $1.2 billion in federal loans they received. In my view, it's unlikely they will pay any significant fraction back. The latest statements show that the failed co-op's non-loan liabilities exceed $1.13 billion, which is 93% greater than their reported assets, including money they expect to receive. On top of that, they owe $1.2 billion to the federal government, as we said. We shouldn't hold our breath on repayment. The American taxpayer is not the only creditor that stands to suffer large losses due to the failure of the co-op program. The latest balance sheets we obtained show the failed co-ops have more than $700 million in unpaid medical claims to doctors and hospitals, unpaid medical claims. In some states, these losses will be absorbed by other insurance companies, which means by the policyholders of other insurance companies who have to pay increased, other insurance companies who then have to pay increased premiums. This is going to go back to our constituents, again, to the taxpayer. In other states, doctors, hospitals, and individual patients stand to suffer large out-of-pocket losses due to the co-op failures, as our report details. We'll talk about this more in relationship to the New York co-op. These failed co-ops were a costly experiment gone wrong, and real people got hurt, including more than 700,000 Americans who lost their health plans. Today, I plan to ask HHS whether they accept any responsibility for the taxpayer waste, the disruption to consumers, and the losses to doctors and hospitals that the co-op failures have brought. At this point, I'd like to ask my colleagues if they'd like to make opening statements. All of you are welcome to